Ladies and gentlemen, we are witnessing the structural dissolution of the global silver pricing mechanism in real time. My name is John A.G., reporting to you live from the newsroom, where the data streaming across our internal terminals confirms that the long-anticipated Shanghai breakout has moved from a theoretical risk to an active systemic contagion. The primary driver is a predatory, relentless, and mathematically inevitable arbitrage trap that has effectively paralyzed the Western bullion banking system over the last 48 hours. To understand the gravity of the situation, you must look past the headlines of simple price appreciation and focus on the widening chasm between London's paper-heavy markets and the physical reality of the Shanghai Gold Exchange. As I speak, the price of silver on the Comex is struggling to maintain its footing at $74.50 per ounce, while in Shanghai, the physical metal is trading at a converted rate exceeding $82. This is not a mere statistical anomaly. This is an $8.00 per ounce vacuum that is sucking the physical lifeblood out of Western vaults with a speed and ferocity that we have never seen in the modern era of precious metals trading. This $8.00 per ounce arbitrage gap represents a massive, unhedgeable liability for the institutional short sellers in the West. Arbitrageurs, sensing blood in the water, are currently executing a drain-and-deliver strategy. They are buying the lower-priced paper contracts on the Comex, demanding immediate physical delivery at the contract's maturity, and instantly rerouting that metal to the east to capture the massive premium. This is a one-way street that ends in vault exhaustion. The data coming out of the J.P. Morgan and HSBC vaulting facilities in London and New York indicates that the reclassification of silver from eligible to registered has reached a fever pitch. In the world of precious metals forensics, eligible silver is metal held in a vault that meets exchange requirements, but is not yet available for delivery against a contract. Registered silver is the actual inventory that backs the exchange's trading volume. What we are seeing is a desperate, overnight conversion of every available ounce into the registered category as banks scramble to fulfill the delivery notices being slapped onto their desks by arbitrage traders. The mechanical nature of this crisis is what makes it so dangerous for the banking sector. Unlike a speculative rally driven by retail sentiment, this is a structural arbitrage. It is clinical. It is cold. It is driven by the sheer math of profit. When a trader can buy silver in New York for $74.50 and sell it in Shanghai for $82.50, they do not care about the long-term fundamentals of the silver market. They only care about the physical delivery of the bar. This has created a run on the bank, but the bank in question is the global silver warehouse system. We have received reports that J.P. Morgan's primary delivery hub has seen more physical outflows in the last 72 hours than it typically sees in an entire fiscal quarter. The stress is beginning to show in the bid-ask spreads and the widening premiums on the retail side, but the true carnage is happening at the institutional level. The Loco London settlement system, which for decades has relied on the assumption that only a small fraction of silver holders will ever ask for their bars, is now facing its Lehman moment. The leverage within the paper market is currently estimated at a staggering 600 to 1. This means that for every physical ounce of silver sitting in a registered vault, there are 600 paper claims circulating in the global financial system. As long as the price remained uniform across the globe, this illusion of liquidity could be maintained. But the $8 Shanghai premium has shattered that illusion. It has acted as a physical magnet, pulling the underlying collateral out from under the paper pyramid. When the collateral disappears, the pyramid collapses. We are now hearing from sources inside the London Bullion Market Association that emergency meetings were held throughout the night. The topic was simple. How many days of physical liquidity remain before a force majeure event must be declared? The timeline is accelerating. At the current daily drain rate of over 1.2 million ounces from registered stocks, the Comex is staring at a total depletion window of less than 30 days. However, the market rarely waits for the final ounce to vanish. The panic begins when the market realizes the final ounce will vanish. That realization is manifesting right now in the form of Rule 589 preparation. For those unfamiliar with the regulatory architecture of the exchanges, Rule 589 allows for the implementation of emergency price banding and a potential halting of trade when price movements become uncontrollable. But a halt in the paper market will not stop the physical arbitrage. In fact, it will likely accelerate it. If the Comex halts trading while the Shanghai Gold Exchange remains open, the price divergence will not just remain at $8. It will likely explode to $20 or $30, as the West loses any ability to discover a fair price for the metal. We must also address the geopolitical dimension of this arbitrage trap. This is not just a market event, it is a resource capture. By maintaining a higher physical price, China is effectively placing a buy order on the world's remaining silver supply. They are utilizing their massive dollar reserves to exit paper assets and enter hard assets, and they are doing so at the direct expense of the Western banking liquidity. Every bar of silver that leaves a London vault for a Shanghai vault is a bar that will likely never return to the Western financial circuit. This has profound implications for the high-tech and industrial sectors in the West. Silver is an indispensable industrial metal, essential for everything from advanced photovoltaics to the guidance systems in our defense infrastructure. As the arbitrage trap drains the financial vaults, the industrial supply chain is beginning to seize up. We are seeing early signs of industrial hoarding, where major tech manufacturers are bypassing the exchanges entirely and attempting to strike direct from mine offtake agreements at prices far above the current spot. The banking stress is now radiating outward. We are tracking a cluster of 4 major European banking desks that are currently trapped in a short squeeze of last resort. These institutions have sold massive quantities of silver call options at the $75 and $80 levels, expecting the paper market to remain under control, with the Shanghai price already breaching the $82 mark. These banks are facing multi-billion-dollar margin calls. This is why we are seeing emergency liquidity injections from the Federal Reserve and the Bank of England under the guise of general market stability. Make no mistake, this is a targeted bailout of bullion banks that have been caught on the wrong side of the physical reality. They are using cash to try and solve a problem that can only be solved with metal, and they are finding that in this environment, cash is a poor substitute for a 1,000-ounce silver bar. The psychological framework of the market has shifted. In previous decades, a sharp sell-off in silver would be seen as a sign of weakness. Today, the informed observer sees a sell-off as a mechanical, forced liquidation by banks desperate to lower the nominal price to trigger stop losses. But these paper raids are no longer working. The physical market in the East is providing a floor that the Western shorts cannot break. Every time the paper price is hammered down in New York, the arbitrage gap widens and the physical drain from the vaults intensifies. The banks are in a catch-22 of their own making. If they let the price rise, they face catastrophic losses on their short positions. If they suppress the price, they accelerate the physical depletion of their vaults through the arbitrage trap. There is no mathematical escape from this loop. As we look toward the next 48 hours, the key indicator will be the delivery notices for the upcoming contract month. If we see a surge in immediate delivery requests, it will confirm that the large-scale institutional players have lost confidence in the paper settlement system. We are already hearing reports of cash settlement offers being made by major banks to their clients. This is a critical red flag. When a bank offers you more than the spot price in cash to not take delivery of your silver, they are admitting they do not have the silver. They are attempting to settle a physical obligation with a fiat instrument. And at a time of systemic distrust, savvy investors are rejecting these offers. They want the metal, not the promise. The divergence we are seeing today is the final act of a decade-long struggle between the paper markets and the physical reality of supply and demand. Silver, as the smallest and most leveraged of the major commodity markets, was always going to be the first to break. It is the canary in the coal mine for the global financial system. The $8 arbitrage trap is the mechanism by which the truth is being forced into the light. We are seeing a historic transfer of wealth and resource power from west to east, facilitated by the very market mechanisms that were designed to maintain Western price dominance. The irony is as thick as the tension in the trading rooms tonight. For the observer sitting at home, the message is clear. The system is in a state of advanced stress. The institutions are reactive, they are late, and they are visibly sweating. They are fighting a war on 2 fronts. against the physical reality of the East and the mathematical reality of their own leverage. Neither of those forces can be defeated with a press release or a manipulated headline. The $8 gap is the siren. The vault drain is the consequence. The systemic breakdown is the destination. Ladies and gentlemen, we are moving into a period of extreme volatility, but it is a volatility born of structural failure, not speculative whim. The 48-hour window we are currently in will likely be remembered as the moment the silver market finally broke free from its paper chains. The drain is accelerating. The banks are cornered, and the metal is moving to where it is valued most. We will continue to monitor the vault flows and the delivery notices as they hit the tape. The information we are receiving suggests that the breakout is no longer a possibility. It is a current reality. The price discovery mechanism of the last 50 years is dissolving before our eyes, and in its place, a new, physical-dominated reality is emerging. This is the story of the $8 trap, and it is a story that ends with the exhaustion of the Western silver vaults. Stay tuned as we continue this emergency broadcast. We are receiving word of new delivery failures surfacing in the London unallocated accounts. This would suggest the contagion has moved beyond the exchanges and into the heart of the private banking sector. If the unallocated accounts begin to default, we are no longer looking at a market correction. We are looking at a total systemic freeze. The magnitude of this shift cannot be overstated. Silver has exposed the rot, and the arbitrage trap is the hammer that is breaking the glass. We are watching the end of an era in real time. As the London markets prepare to open in a few hours, the world's eyes are on the bullion desks. Will they attempt one last massive paper dump to close the gap? Or will the sheer weight of physical demand from Shanghai finally break the resistance and send silver into a parabolic, uncontrolled ascent? The math says the breakout is inevitable. The banks say they are in control. The vaults, however, tell the only story that matters. They are emptying. And once they are empty, the paper price of silver becomes an irrelevance, a ghost of a system that no longer exists. The industrial users are now the most desperate players in this drama. We have just received a report that a consortium of European renewable energy firms has petitioned for an emergency meeting with the European Central Bank. Their concern is not the price of silver, but the availability. They are realizing that if the arbitrage trap continues to ship the world's refined silver to the east, the Western green transition will come to a grinding halt. This is where the financial crisis meets the real economy. This is where the silver-led systemic stress becomes a matter of national security. The banks are not just losing a trade. They are losing the metal that powers the 21st century. We are seeing the 600-to-1 leverage ratio begin to unwind in the most chaotic way possible. When you have 600 people thinking they own the same ounce of silver, and that ounce is suddenly loaded onto a ship bound for Shanghai to capture an $8 profit, the other 599 people are left holding nothing but a digital entry. That is the essence of the crisis. That is the reality of the $8 arbitrage trap. It is the great unmasking of the precious metals markets. The technical levels to watch over the next few hours are the $76.20 resistance on the Comex and the $83.50 level in Shanghai. If Shanghai pushes further, the vacuum will only grow stronger. The vault drain will only move faster. We are in the acceleration phase of the collapse. The smart money has already moved. The institutions are now fighting for the scraps. The registered silver inventory is the only number that matters now. Watch it, because when it hits zero, the game is over. The silence from the major financial news outlets is deafening, but the noise in the bullion vaults is louder than ever. It is the sound of bars being moved, of crates being packed, and of a system being liquidated ounce by ounce. This is the forensic reality of the silver market today. The $8 trap has sprung, and the Western banking system is the prey. We are documenting the fallout as it happens. The breakdown is not coming. It is here. As we conclude this segment of our emergency coverage, remember that the silver market is the diagnostic lens through which we can see the true health of the global financial system. Today, that lens shows a system in a state of advanced, irreversible failure. The arbitrage is the proof. The vault drain is the evidence. And the coming days will be the verdict. The era of paper control is ending, and the era of physical truth has begun. The $8 gap is the bridge between those two worlds, and it is a bridge that is currently being burned at both ends. We will remain on the air as this situation develops. The next few hours are critical. The liquidity of the world's most important industrial and monetary metal is at stake. The banks are at the limit of their endurance. The East has made its move. The West is out of time. This is the reality of the global silver-lead crisis. This is the story of the $8 arbitrage trap